at our final training session for the 2022 calendar year, and we'll be discussing a little bit more about items that aren't going to be found in your 4012. So today's session, we're going to be going through and talking a bit more about a few different areas that are going to be important for tax preparation, but just a little bit different from what we have here in terms of information provided through the IRS in the United Way. So we're going to be talking more today about Pennsylvania state tax issues, local tax issues as well, and also touching on some concepts for the military and also deceased taxpayers. So I'm going to go ahead and bring up our information here, and hopefully, all right, I'm going to work with my multiple screen environment to make sure it is going well. Okay, and hopefully we are all set. How are we feeling in terms of the visuals? Were you able to see the slide set on screen? Okay, wonderful. We'll go ahead and, as I mentioned, talk more about Pennsylvania state tax issues today, local taxes, deceased taxpayers, and then I'll give you a little bit of a warning as we move into the military section. That is a separate area for purposes of certification, but I'll let you know when we move in there in case you are not interested in doing that certification and you would like to drop off. We'll be more than happy to allow you to enjoy the rest of your evening. So, great news about our section tonight. Really not a whole lot of changes from the prior year, other than updating some dates. So when we take a look at the requirements for state and local taxes, we are going to just remind you that for Pennsylvania returns, if an individual has more than $33 of gross income, they are to be filing a PA return, even if there's no taxes due. So that would include items of wages, could also include interest, dividends, capital gains, and a couple other things that I'll enumerate as we go through these sources of income for Pennsylvania. Also, if you had any losses, even though we're technically not doing these within the VITA program, but if you had a loss from a sole proprietorship business, if you are a partner in a partnership or a Pennsylvania S corporation, you're technically supposed to file as well. Also, just as a reminder, Pennsylvania does not have a exemption for minor children. So there's actually no age limit on Pennsylvania return. So anyone of any age with $33 of gross income is expected to file a return. Now, in practicality, we may not have to file for children that have UTMA accounts or get some brokerage accounts that are in their name, just because it most likely will not have a tax impact. But the technical rule, we have to take a look at $33 of gross income to determine whether or not someone should be filing a return. Now, for Lancaster County, this is a little bit different. This is only based on earned income. So the local return is only based if you have earned income or net profits. So we're looking at the position where if you have self-employment, if you have a transaction as a partner in a partnership, that would give indication that you should be filing a Lancaster County return. Now, this tax only applies for individuals age 16 and older. So if an individual is less than 16, they do not need to file a Lancaster County return. They may have an issue if for some reason their employer withheld local tax and they were not subject to the tax. They can still file a return reporting zero income, or any income they earned before the age of 16 can be disregarded, and we'll put the full amount of the withholding in there. Usually we want to attach a small statement just to say that the individual did not turn 16 until their date of birth, and we'll just indicate that and then apply for the refund. So the Lancaster County tax would be the tax collection authority for all of Lancaster County and part of the Octorara School District, even though that's in Chester County. So if anyone lived in Lancaster or Octorara for any part of 2022 and they had earned income, they should be filing a Lancaster County return. One other item I just want to mention about the local return is if a client comes in and they have a pre-printed form from the LCTCB or the Lancaster County Tax Collection Bureau, we should be filing a local return for them, even if they have no earned income. If Lancaster County's gone ahead and submitted a pre-printed form, it means that that individual's in the Lancaster County system, and Lancaster County would be expecting a return. So if they don't have earned income any longer, you can simply go ahead and use that pre-printed form, check off one of the boxes to say retired, unemployed, or maybe deceased. I keep trying to check deceased on my return each year. I keep getting a brand new one each and every year. But we do want to go ahead and make sure that we clear that account. Otherwise, they'll probably get a non-filing notice generally later in the year, and creates more work for Kim and Jennifer when they get calls to say what happened with our local return. why are we getting a notice threatening to be sent to jail? So if you get a pre-printed form, we suggest that we have that filled out and sent back. Good news is the Lancaster County return can be prepared within TaxSlayer again this year, and I'll give you some tips and techniques of how we can do that throughout the session. Just a couple other interesting parts about Pennsylvania tax law. It is different from federal. So federal has their own system, basically the gross income. We take a look at deductions. We take a look at a couple other things. We can offset losses in one category with gains in another. Pennsylvania has a completely different system. So Pennsylvania has a unique method because we can only have a flat income tax rate by the state constitution. So we can only have a flat tax, no graduated rates like we see within the federal process. But Pennsylvania only taxes 8 classes of income. So if the income is not included in one of these categories, it's not going to be taxed for Pennsylvania purposes. So we'll go through a couple of these categories. The first one being wages. So if an individual has wage income, it's going to be taxable for federal, also going to be taxable for state, and also local purposes, because wages will be considered earned income. And I'll go through a couple different changes about compensation and how they're going to be different potentially for federal purposes. Also, interest income generally will be taxed the same way for Pennsylvania as it is for federal. I'll go through a couple quick adjustments there. Might be some areas of interest that would be taxable for federal, but not for PA. We'll talk about how to make some of those changes. Dividend income, again, typically will be carrying over from the federal return. Just want to mention, if you have the 1099 DIV, typically it'll be the ordinary dividends. It'll be taxable for Pennsylvania purposes. Just want to point out, if you're taking a look at the return, you're self-checking, and you notice that the dividend number is different for PA as it is for federal, you may want to double check. When we have the 1099 DIV, if the individual has taxable gains, or basically capital gain distributions, for federal return purposes, those are treated as capital gain activity. For PA purposes, TaxSlayer automatically recategorizes those as dividend income. So it will automatically include those as dividends. So if you notice that the dividend information might be a little bit different for federal and state, probably that's what's happening. I don't think we'll see a whole lot of those within VITA, but in case you see something there, that's most likely what's happening. Also, business income. So if you have self-employment income, the amount from the Schedule C should be coming over to the PA return. Again, those numbers should be fairly close. There are slight differences in terms of some deductibility, but with the federal and state both having 100% meal deduction for 2022, those should be relatively similar numbers, just to double check. Any gains or losses from the sale of property, again, should be the same as federal, with the exception of any capital gain distributions from an investment account. Those might be reported again as dividend income. The next two categories are technically out of scope for VITA. So that's rent and royalty activity. So rental activity typically has concepts like depreciation and a couple other expenses that are just more difficult for us to prepare within the VITA program. Royalties are also going to have some additional deductions that are kind of outside the scope of VITA. Estate and trusted income would be our next category. Again, this is typically coming off of an individual who might be a trust beneficiary or maybe receiving a distribution from an estate. The rules are a little bit more complex. In actuality, it's not that difficult to put them in, but by the VITA rules from the IRS, we cannot prepare a return with estate and trust income. Now, as I mentioned that, the estate and trust are actually fairly easy to work with if you're getting a K-1 or a trust letter. So if you're preparing returns for friends and family, absolutely, you may use the program for those. Last category I just want to talk about is gambling and lottery winnings. So this is including gambling and lottery winnings wherever earned if you're a resident of PA. That includes any lottery winnings with the Pennsylvania Lottery. Also includes Powerball and Mega Millions. A couple of years ago, there was an exception if you won Powerball or Mega Millions if you purchased a ticket inside Pennsylvania. That has been repealed. So any gambling or lottery winnings you have would be included in income. Now, the good news for gambling and lottery winnings is you can actually offset your gambling and lottery winnings in PA by your gambling and lottery losses. So you can deduct up to the amount of your gambling and lottery winnings. There is no prohibition against the deductibility. For federal purposes, we can only take the gambling losses against the winnings to the extent that we itemize deductions. So if you can't itemize deductions on the federal return, there's no benefit for the gambling losses. For Pennsylvania, however, they can be directly offset. So a pretty nice advantage there. Now, talking about deductions, we don't really have that many deductions for Pennsylvania tax purposes. I will cover those a little bit later. But what's unique about the Pennsylvania rules is that if the income is in these classes, we will add up all the positive numbers. So usually all these should be positive. Wages, interest, dividends should not be a problem. Business income, we technically do not provide services for individuals with a business loss, but you could have a gain or loss from the sale of a property. If you take a look at the return, Pennsylvania will not allow you to take a loss from the sale of stock or a mutual fund against income from another class. So we cannot take losses from one class against income from another. The other interesting part about Pennsylvania is you cannot offset losses from a spouse with a taxpayer. So even though the return looks like a joint return, you're actually filing two different returns at the same time. Just for convenience purposes, they're on one form. So, for example, if one spouse has a $1,000 gain from the sale of securities and the taxpayer has a $2,000 loss, the PA 40, the individual income tax for PA, is only going to show the $1,000 of gain. You may not offset the losses from the spouse with the taxpayer. So, just some interesting wrinkles with Pennsylvania returns. Generally, we're going to see all these be picked up automatically within TaxSlayer. So if the return looks odd, it's probably just some unique adjustments that are being made for the Pennsylvania tax rules. Now, good news is you may have heard recently that Lancaster County was rated one of the best places to retire in the country. We had a comment earlier today because of the VITA program and all the things that we do here inside the county. A lot of other benefits as well. Outside of it getting cold and dark relatively early, a lot of benefits for being here in central Pennsylvania. One of those is the fact that Pennsylvania does not tax the following sources of income. So things like Social Security, railroad retirement benefits, pensions and retirement distributions, and there's an asterisk there. So you probably know I have a little bit of a exception rule coming up here. But generally your retirement benefits, your Social Security and pension are not taxed in PA. Also not taxable, unemployment compensation, any sick pay and disability payments. Alimony has never been taxable in PA. So even though the federal rule changed after 2018, alimony's never been taxed in PA. Another thing that we take a look at, inheritances and death benefits, not taxable in Pennsylvania purposes, much like for federal. I will come back to inheritances though as we talk about some of the special rules for PA. Also, active military duty pay. We'll talk about that as we get to the tail end of our session this evening. The only exception we have here, why we have the pension and retirement distributions with an asterisk, is as long as the employee has met eligible retirement age and they have retired, the benefits are not taxable. So what we're looking at here is a 1099-R, which would normally report our retirement distributions, should have a code 7 in it. If it does, Pennsylvania is not going to tax those amounts. However, if you have a distribution with a code 1, much like we talked about for the income training module, the code 1 indicates that we have an early distribution from a retirement account. So that would be considered actually taxable wages for Pennsylvania purposes. Now, the good news is that not all of it's going to be subject to tax in PA. Pennsylvania effectively was the initiating force behind the Roth IRA. When we talk about wages, there may be a difference between federal taxable wages and Pennsylvania taxable wages. And the reason why is because the federal government will allow a deduction for contributions made by the employee to their own retirement account. So that could be a 401k, a 403b. And we'll notice that we have a a code in box 12 that'll indicate that the individual made a contribution to their retirement account. So Pennsylvania does not allow a deduction on the way in, but also doesn't tax any of those retirement distributions on the way out, as long as you met normal retirement age. If you did not meet normal retirement age, and again indicated by that code 1 in box 7 on the 1099-R, Pennsylvania would treat that as additional wage income. Now, the good news is that it's, again, not taxed in full. Any amounts that the employees have contributed to their retirement account is considered a return of basis, effectively non-taxable income. And we actually get to make that deduction from the very beginning. So nothing's taxed until we've exceeded all the initial contributions by the taxpayer. So the question may be, how do we know how much the taxpayer has contributed? Well, the good news is if they've only been contributing for the past year or maybe the prior 2 years, we can find this information off the W-2. As I mentioned, you'll find that that number will be in box 12, usually with a code D or code E, would indicate the employee's contributions to a retirement account. So if they have $1,000 showing on the 1099-R with the code 1, they bring their W-2s in and we see that they have $800 that they had put into their retirement account. The first $800 is non-taxable. So for PA purposes, it's a $200 tax amount. So that would be taxable not only for Pennsylvania purposes, but also for local tax. And we just need to enter that in TaxSlayer as other income on the return in order for that to come over appropriately. So good news is Pennsylvania does not tax income unless it falls in one of those 8 categories. So some other things you may see on here would be the fact that any of your debt forgiveness would also not be taxable as well. All right. And looks like we have a question coming in. A person 55 and a half, still working, but takes an IRA distribution to buy a car. Would it be taxable or not taxable for PA? If they have met eligible retirement age, they would not be subject to tax. So traditionally, as long as they meet the retirement criteria, the 1099-R will probably not indicate a code 1. So if they're 59 and a half, they have probably met the retirement age capabilities, so it would traditionally not be taxed in PA. So the money doesn't have to be used for necessarily for direct retirement purposes. So we may have people that may retire from one job and go take another one. Obviously, their pension and retirement distributions are not going to be taxed for PA because they have met the eligible age for retirement with their employer. So from that aspect, they should be okay. All right, wonderful, great. So moving on to kind of the compensation issue. As I mentioned, what we're going to see here is that typically the PA taxable income will be different from the federal wages. So federal wages in box 1 of the Form W-2, that's going to flow through to the federal return. As I mentioned, Pennsylvania does not allow deductions for retirement plan contributions. So what we're going to see on box 16 may very well be different from box 1. Now, typically Pennsylvania follows almost a similar rules that Medicare wages have. So typically PA wants to see that box 16 looks very much like box 5. Good news is we do not have to go back and try and reconcile those wage differences. If the wages are shown in box 16 on the W-2, we'll just enter those into TaxSlayer. The state withholding should be 3.07% of box 16. We have a flat tax rate. So the state withholding should be in box 17. We'll enter that into TaxSlayer. The local wages should be in box 18, along with the local withholding in box 19. So we just need to enter that information in to TaxSlayer, just ensuring that we have the correct state wages and withholding. Typically what may happen is here in Pennsylvania, TaxSlayer will give a warning to say, hey, by the way, your numbers may not be matching. That's fine, because we know that there's a difference between federal and state wages typically if they're using a employer-based retirement plan. Just one other thing to watch out for on the W-2, there should only be one line for local earnings. And I may reverse that in a little bit here. But typically what we'll see is that the local wages are going to be reported again in box 18 and total withholding in box 19. There may be an occasion where an employee may have moved or changed local jurisdictions, which may have differing tax rates or maybe just change an address. So just double check to make sure that the amount in box 18, there are 2 lines, adds up to the one on box 16. So that's what the local is going to be looking for. If that happens, we'll just enter all the amount in. So you don't actually have to add separate lines. We can just add that together and make sure it flows over to the tax return appropriately. What I do want to caution is sometimes an employer may put local services tax as a separate line on the W-2. Now that information should actually be in box 14, which effectively is not reported on TaxSlayer at all. It can be used if you're itemizing deductions. Some employers create their own rules and they'll actually put what they call the local services tax on the local wage line. So we can just disregard that. Usually if you see $52 for tax withheld, that's the local services tax. That's not to be entered into the return. A couple other things we have with wages. So the nice part is as because we're here right near the Maryland border and right near a couple other states. Pennsylvania realizes that individuals here in PA may be working in other locations. So as long as the individual is working in one of the states which we have a reciprocal agreement, and a reciprocal agreement means that Pennsylvania and the other state have agreed that instead of withholding the state tax for where the individual works, that the employer should be withholding tax for where the individual lives. So that prevents us from filing multiple state returns, which is great because here in VITA, we do not file multiple state returns. We're going to just file PA returns and Lancaster County returns only. So the reciprocal agreements are typically for states that are right near or bordering PA. Now, as I mentioned that, when we take a look at our alphabetical list, the first state that pops up is Indiana. Again, not quite sure when people may have had their last geography course, but Indiana is not next to PA. You have a couple states to get through in order to get to Indiana. I've yet to see a client that commutes on a daily basis to Indianapolis, but good news is if they do work in Indiana for an Indiana employer, the employer can withhold PA taxes, which means we don't have a filing requirement for Indiana. So some other local states as well would be Maryland. Again, here in Lancaster County, very popular for individuals to cross the Mason-Dixon line to go work in Maryland. Also New Jersey, Ohio, Virginia, and West Virginia all have reciprocal agreements, meaning that theoretically that they should have PA taxes withheld, and therefore we don't need to file an out-of-state return. If for some reason that we see a W-2 coming from a Maryland employer and they're showing Maryland taxes withheld, unfortunately, a Maryland return needs to be filed in order to get that money back. So they should not have to pay tax in Maryland if they're a non-resident employee. They would have to file a PA return. So we may have some complications there, and it does not work well with VITA to multi-state returns. I do want to mention there are two states that are very near Pennsylvania that are not on this list. One is New York. New York does not reciprocate well with others. If you are near, thinking about, or have ever considered being in New York, they want to tax you. So if you have an employer in New York, typically they will have to have New York taxes withheld. It becomes a little bit more of a complex issue. We hopefully should have as many people here in Lancaster County under the VITA program that run into these areas, but we are seeing a little bit more people who are telecommuting or working remotely for other employers. So we just have to watch to ensure that we don't have a multi-state requirement, because unfortunately we cannot handle that here in the VITA program. Another state that's not on this list, and I will talk about them a little bit later as well, is the state of Delaware. So Delaware does not have a reciprocal agreement with Pennsylvania. One area where I see this potentially come into play a little bit more is if you have someone who might be working in the areas of construction or maintenance work, and they are sent to Delaware for a brief period of time, their payroll company may show some Delaware wages and Delaware taxes withheld. If it's only a couple dollars, and I've seen this before where an employee has been down there for maybe 2 or 3 days, and there's maybe $120 or $200 worth of wages and a couple dollars of tax. If you so choose, or the client so chooses, we can just file a PA return. We pick up all the income in PA and kind of disregard the Delaware issue. They are allowed to go out and file their own out-of-state return if they like. We can prepare everything else. If they're working consistently in another state, they probably will need to go and get outside assistance with the multi-state return. So just an unfortunate issue we run into here with a multi-state environment. Now, as we talked about the ability for deductions, Pennsylvania really does not have that many deductions because we only include items of income. Now, one area that's a little bit different is because we have a Schedule UE, which is an unreimbursed employee expense. Technically, it'd probably be the Schedule UEE, but for sake of ease, we're just going to call it the UE, unreimbursed expenses. So Pennsylvania does allow a deduction for employee business expenses without having to itemize. So for federal taxes, years ago, we used to have an unreimbursed employee expense category. It was part of the itemized deduction. Once we made some changes and increased the standard deduction, they took away the unreimbursed employee expense at the federal level. Now, again, when we talk about military, that comes back into play, but for the most part, we do not have any unreimbursed expenses at the federal level. We can take those here for PA, however. So a couple rules. It has to be ordinary and necessary in the industry. So it has to be related to what you do. Actually paid for performing the duties of your employment, has to be reasonable in amount and not excessive. It has to be effectively needed for you to continue your job function, and again, directly related to what you're doing. So the most common examples we have for unreimbursed employee expenses would be union dues. So these are going to be predominantly found on educators, if people are involved in the public school system, people who might be in the manufacturing or other industries that have a union due. They have traditionally been reported on the W-2. However, we've seen a bit of a change that the union dues may be paid outside of the employment context. So you may just want to inquire if the individual had any union dues. Again, not deductible for federal, but they would be deductible for both state and local purposes, because the Schedule UE would also carry over to our local return. Other areas that we can see here, talk about educators, the educator expense deduction, the thing that we had talked about on our deductions the last time we met, would be also allowable for Pennsylvania purposes. So any of those classroom expenses, for federal purposes, we had a $300 cap. So if you had more expenses, you could only take up to $300. For Pennsylvania, there is no $300 cap. So if an individual comes in and says, I had $410 of classroom expenses, for federal, it's going to limit it to $300. For PA, we can take all $410. So as long as it's related to the job performance, we can go ahead and take those expenses. Okay, great. So question coming in from Richard: noticed the educator expense in tax lawyer practices limited to $250. Thought it was increasing to $300, but the tax lawyer practice is not allowing $300. That is correct. It is actually $300, updated here for 2022. So the question is, how's it going to impact the advanced test, which asks the question in scenario 7. That is a good question, and I'm not quite sure how that's going to impact. There obviously is going to be a bit of a difference, because the actual 2022 rules allows for up to $300. And I'm not quite sure. I don't think, Kim, we've had many people submit the test results back yet.
Not yet. I am part of a roundtable group, and this is one of the issues that they've brought up, about how it should be 300 and it's only showing 250 in tax layer. So it is one of the glitches that hopefully tax layer will be aware of and will get fixed. But
all right, so stay tuned. Kind of issue aware type issue. Okay, perfect. So at least we know that there's a glitch within the practice program. But I believe the actual live version should have that updated. That is, the practice version is a little bit different from the live version. The live version is what the IRS actually will sign off on. They are more concerned about what happens back in the when we start filing the returns. But hopefully they can fix that. I know it's been down a couple times. So hopefully while it's down, they can go ahead and make their corrections. All right. Yeah, and great question. So hopefully they have that fixed before taking the test, so you do not have the issues of not getting that question correct on the exam. And I think that might be something, I know it's on the would be on the advanced certification, I believe. So I think what we'll probably do is keep an eye on that, and if there's an issue, it may be just something we can pass along. I think, Kim, if there's problems that people are running into, that we can try and see how we can best work around that issue. We'll just call it that.
yeah, I know Mike has already taken the test and passed it, so we can check with him.
Okay, perfect. Yep. All right. Wonderful. Okay, some other common expenses that we have for unreimbursed expenses would be things like work clothing and uniform. This is always a unique category, because it is allowable as long as the clothing's not adaptable to general use and has to be required to be purchased by the employee. The employer is going to require them to purchase it. And I also just want to make another comment for the unreimbursed employee expenses. Under Pennsylvania rules, you are not allowed to claim a deduction for an expense that you could have been reimbursed by your employer. So Pennsylvania will say, if you had the ability to turn in receipts, to turn in your travel vouchers, to turn in any of these items for reimbursement, but you failed to do that with your employer, Pennsylvania will not allow that to be a deduction. So the actual rules for PA say, if you have the ability to be reimbursed by the employer, you have to go to your employer to be reimbursed. Even if they don't reimburse the full amount that might be allowable, or they provide a mileage reimbursement less than the federal rate, you are not allowed to claim that additional amount for PA purposes. So just something they've been cracking down on a little bit more as of late. Gives them the very quick ability to find out if there are any issues with the Schedule UE. I don't think we're going to run into many of those issues here at VITA, but just want to give you that update. The other question we sometimes have is work clothing and uniforms. If someone says, well, I have to look professional, so I have to buy a button-down shirt and some nice sweaters, can I take that as a work clothing? Well, probably not. The requirement from your employer may be you have to look presentable. But if the clothing's adaptable to general use, if you can wear that shirt, if you can wear those sweaters outside, it's probably not going to be considered a requirement of employment. What they're looking at here are uniforms, things like scrubs, things like safety clothing and safety equipment. So maybe a high visibility vest or shirt that you might have to wear for safety purposes, steel-toed boots, maybe things that are flame retardant or fire retardant that are used in certain professions. Coveralls could be one. And this has been kind of a slippery slope for a while because usually when we first talked about work clothing and uniform, the basic litmus test was to say, if you did not feel comfortable walking around outside a work environment with the clothing on, it's probably required work clothing. So if you didn't want to be caught walking around the mall in your coveralls and smocks from work, it probably was going to be just used for work purposes. However, when we take a look at society today, apparently there's no clothing standards anymore. So whatever you will feel like wearing, just go ahead and wear. So we can't use that as a test anymore. We just basically have to say, is it clothing and uniforms required for work purposes? So if it's required by the employer and not generally adaptable to general use, we can take it as a deduction. So unfortunately, that means if you have someone who's a landscaper and they decide they want to buy a brand new jacket because it's getting cold out now, but they also love that jacket because they can take it deer hunting, it's not going to be considered work clothing and uniforms. It's just normal clothing expense. Also would be includable in there would be things like small tools and supplies. So a question coming through, healthcare uniforms deductible. Yes, so typically things like scrubs and healthcare uniforms would be considered deductible areas. Again, particularly if they're required by the employer. And typically we're not anticipating people to wear scrubs on a normal basis. Yeah, they might be fairly comfortable, but we're not seeing a whole line of fashion within the kind of medical gear. So scrubs typically deductible. Yoga pants not deductible unless maybe you're a yoga instructor and you have to wear them. But we just generally take a look and see what kind of occupation you're in and whether or not they're required for your profession. Small tools and supplies, it might be things that you might have to pick up. Again, this is where the educator expenses come into play. If you are maybe in a profession of, again, a contractor or repair technician, hopefully your employer is reimbursing you for those. So we may not see a whole lot. And again, kind of talking about the healthcare profession, professional licensure fees, as long as they're not reimbursed by the employer, can be deductible as well. So if you have nursing professional dues or things along those lines, those can be considered Schedule UE eligible. Any vehicle expenses that aren't commuting costs, again, vehicles are typically going to be reimbursed by the employer. So we hopefully don't see many of those. Again, you have to have a mileage log to show where you've been. Any tolls, transportation, that type of thing, travel when you're away from home overnight. And again, meals and entertainment, you do get 100% of those at all times in PA. You do not have the 50% at times limitation like federal has. PA is very much on board about 100% meal and entertainment deductibility. Again, but you cannot have the ability for reimbursement by your employer. If you pass those hurdles, you can go ahead and file Schedule UE. Generally, because of the flat tax rate, it's not going to give you a huge amount of refund, but can offset perhaps other income sources you may have. Again, that would also be eligible for local purposes. So if you get to take it for PA, you also get to take it for local. Just a couple other things we take a look at here for interest income. So I mentioned that generally some differences might be wages. Interest income can also work a little bit differently. So Pennsylvania does not tax interest from the U.S. government. So when we say U.S. government is not getting if you got interest on a refund, the government took a little bit longer to process. That's not what we're talking about. We're talking about savings bonds, things that are reported on a 1099 INT in box 3. So hopefully with the 1099 INT in box 3, that should automatically prevent it from going to PA. I am going to talk about a couple other areas here. So Pennsylvania also does not tax interest from itself. So if you're going to invest in Pennsylvania bonds or any governments of Pennsylvania, so usually municipal bond interest from things like the school district or counties also are not going to be taxed in PA. So the good news is we have a lot of taxing jurisdictions in Pennsylvania. I mentioned in this morning's class, I believe the latest statistic was we have more taxing authorities in PA than most of the rest of the country combined, just based on the way our governments are formed, that we have the Commonwealth as a whole, we have the counties, we have individual school districts, and then we have municipal areas like towns, boroughs, townships, hamlets, all kinds of little villages we have that all have taxing authority. So any interest earned off of these accounts would not be taxable for PA. The way that we would probably see these would be coming off of a brokerage account. So if someone has, say, a municipal bond fund, that would not be taxable for PA. I'm sorry, municipal bonds would not be taxable at all for federal purposes, but only the interest from Pennsylvania sources would not be taxed for PA. So we may actually have to make an adjustment on the tax exempt interest to either add or edit some of those. Another interesting part is, in addition to Pennsylvania municipal areas not being taxed for interest, U.S. territories. So any interest from bonds or obligations from Puerto Rico, the Virgin Islands, or Guam also would not be taxable. We have yet to see that, I believe, at a major level here at VITA. Quite honestly, I have been searching my entire career for a bond from Guam. So I just love to see what one of those looks like at some point. If you do have those, just remind yourself that the interest from those bonds not taxable in PA. If you can very slyly take a picture of that, and I'd love to see it. I'd love to see what a bond looks like from Guam. Not taxable for PA though, so we don't have to worry about any of those being taxed. Also not going to be taxed for federal either. So while PA doesn't really have a lot of deductions, we'll talk about a couple of them coming up here. One of the main areas we have is tax forgiveness, which is called the Schedule SP. The one downside we have within VITA is this is not an automatic calculation. Within TaxSlayer, you have to go in and check that the taxpayer is eligible for SP. Kind of a best practice tip is just check everyone off to see if they're going to be eligible or not. If they're not eligible, the system's going to go ahead and just not give them the SP. So it's not that it's a problem if we check it and they're not eligible. So generally, we're going to use that based on their amount of income, generally following PA taxable income. There are certain things, however, that get added back. And when we take a look at the Schedule SP, we have a lot more benefit for once we get past the taxpayer and the taxpayer and spouse. Once we add more children to the calculation, we have a higher amount of eligible forgiveness income. So while Pennsylvania technically has a flat tax, they found a back way around it by putting a Schedule SP in, which effectively allows a credit against your income tax. So it can reduce all or part of the tax liability. Again, this is calculated each year. So if someone qualified in years past, maybe they don't qualify this year. If they have additional income, maybe they have capital gains, maybe they have gambling income. There might be some things that changed in their between year to year that cause their income to go up, which would cause your SP eligibility to decrease. Also, there are some things that we may have to add back. So alimony, while we mentioned it's not taxable for PA purposes, it has to be added back for SP forgiveness. If we have taxable alimony on the federal return, it should automatically come over to the Schedule SP. If they have that divorce happening after 2018, we'll have to manually add the alimony received into the SP calculation. Non-taxable interest, so what we just got done talking about here, with the interest coming from sources not taxed to PA, will automatically be added back. Now, two other things on here might be a little bit more applicable. So we talked about inheritance being not taxable for federal, not taxable for state, not taxable for local. So if someone comes in and says, I inherited $5,000 from an aunt or an uncle, great. We typically don't need to worry about it until we get to the SP and also to the property tax rent rebate that I'll be talking about in just a little bit. So we may have to inquire to see, did you have any inheritance money received last year? If so, we need to add that back in the SP schedule to see if it is going to be calculated for the SP ultimate determination. Also, one other area that could be problematic, particularly as people are downsizing from their current home, while we have a gain from the sale of principal residence, not going to be taxable for federal, not taxable for PA, $250,000 for an individual, $500,000 for a married filing jointly couple. That amount of excluded gain would have to be added back for SP purposes. So if an individual selling a home, they had a $50,000 gain, they're not going to have any federal or state tax on it, but we would have to go ahead and do the calculated amounts. Question coming in about inherited IRA withdrawals. Those are actually not taxable for PA purposes, and I would have to double check the PASP if that is added back. That is a very good question, and unfortunately, off the top of my head, I do not know. So I would have to go ahead and double check that. Typically, that information is, if it's in the system, which a IRA received with a code 4, effectively an inherited IRA, would normally carry over if it would be part of that SP change. And I apologize, I don't have that off the top of my head here, but we can take a look at that and verify for that. But one other area we do need to watch out for, when you check that box to say someone is eligible for SP, I just want to have a caution here if that taxpayer is a dependent of another. So two things. One, if an individual comes in and they are saying that they're a dependent, or they might be a college student, and they are want their return done through VITA, we want to double check two things. One, are they considered a dependent of another? Because if we do not elect in that entry information that they're a dependent of another, the IRS will automatically give them effectively a dependency exemption. Not that it really matters that much, but the problem is when the parent goes to file for the return, they're going to get a warning diagnostic to say the return can't be filed because someone else claimed that dependent on their return. So if you do get someone coming in that is a dependent age, we just probably want to verify to make sure that they are not going to be claimed by their parent. And if they are, it means that we have to double check to ensure that we've checked the box to say dependent of another on the return. And also for tax forgiveness purposes, the individual is only eligible for tax forgiveness if the parent for that dependent is also eligible for SP. So hopefully what's going to happen here at VITA, we may be having a family come in and maybe we're doing the return for the parents, and then the child also had a little bit of income and they want that return done as well. So if we're doing it all at the same time, not really a big deal, but we just want to double check if you have an individual who could be dependent, that they have a issue on whether or not they can claim themselves on the return, and two, whether or not they'd be eligible for tax forgiveness. Just a couple other issues with PA before I get into some more deductions. A couple other areas that are a little bit unique, and we may or may not see those here in PA within the VITA program. But if an individual has purchased a private commercial annuity, and what this is basically coming from an insurance company or maybe a mutual fund company, and the way that the annuity would work is that they, the broker or advisor would talk to an individual and say, if you give us a certain sum of money, maybe $50,000 or $100,000 today, we will pay you back over a period of time or over your lifetime a certain monthly payment. That would be an annuity. Also, a gift annuity could happen if you're going to go ahead and provide an annuity to a charitable organization. Any of the earnings from those accounts are going to be taxable for PA purposes. So that's not a retirement account. Even though it's coming off a 1099-R, that's not going to be considered a retirement account that's exempt. So what we're going to see is this is usually going to be indicated with a box 7, which looks great. And then you'll see a D. So a 7D means that it's a distribution from a non-retirement annuity or a gift annuity. So if you see those on the 1099-R, just make sure you enter those in the appropriate box, box 7. And from my understanding, it's right now still calculating over automatically to the PA return. So we just want to be sure that that's going to show up and reported as interest income, because it's actually considered an earnings on the account. Another question that arises is whether or not we need to report use tax on a return. So good news is when we had our predecessor program, TaxWise, it actually required this question to be answered. TaxSlayer doesn't really seem to mind as much. Use tax is I'll try and boil it down as quickly as we can here. So sales tax is effectively imposed on various items purchased from Pennsylvania retailers. So if an item's subject to sales tax and you buy it here in PA, your purchase price is increased by that amount of sales tax. The vendor is going to collect it and then remit it to the state. What use tax is a corollary to sales tax. It's basically saying if you did not pay the appropriate amount of sales tax, you would owe use tax to the state. So if you bought a product that would have been taxable here in PA, but you bought it online and they didn't charge sales tax, or you bought it out of state, and I mentioned one of the states that we don't have a reciprocal agreement with, Delaware. If you've been to Delaware, you've driven in, you'll see the Welcome to Delaware sign. The first state, beneath that, home of tax-free shopping. And they recently added home of Joe Biden. So we still see that they still love that home of tax-free shopping. If you buy items that are taxable in Delaware and bring them back for use in PA, Pennsylvania says you owe us the tax. So before I get everyone kind of all scared and do I owe any money to PA, the good answer is no. Use tax for individuals is a voluntary compliance. There is no mechanics out there that require an individual to pay use tax. There are for businesses, but not individuals. So the way that Pennsylvania gets around that is to say, why don't we put a question on our PA 40 to say, do you have any use tax that you would like to pay with the return? Now, the interesting part is that if you pay any of these amounts, it's effectively just a gift to the Commonwealth of PA to go into their general revenue coffers. There's no mechanics of how it works. You can actually have zero liability. I believe most of our clients here at VITA don't even bother to answer the question. We may not even ask the question all that often, but zero is fine. You don't have to report. It's a voluntary report. Some individuals may say, no, I think I would like to contribute to the Commonwealth of PA, and I want to be sure they have enough money to keep our state running. Well, if you didn't keep detailed records, you can actually have an estimated use tax. So if you have less than $15,000 of income, the system will go ahead and put $6 of additional tax on there. 15,000 to 30, it's 12, 30 to 50,000, 17. So you don't need to keep meticulous records. Now, I actually have had clients in the past that were very detailed, and they had pages and pages and pages on a spreadsheet of all the items they purchased and whether or not tax had been paid. So they actually and indicated that they said, I bought something for someone in PA. I don't think they charged me the right amount of tax. So here's how much more I owe. Plus, here's how much I bought online. When I was in Delaware, I bought a couple things. I didn't pay tax on it, and I want to pay tax. You can actually go through the calculation, put a number down. That's fine too. It doesn't often happen here in PA, but you're more than welcome to do so. Again, on optional piece, there's no penalty if you fail to report use tax. Just a couple quick issues on the PA 40 here. There are a couple other deductions that may be applicable. Now, not potentially for our VITA clients, but maybe more so for kind of your own personal use if you're working with friends and family. Section 529 contributions. So these are effectively savings accounts for college that the taxpayer can deduct up to $16,000 per year in contributions per beneficiary. The good news is this does not need to be for a PA resident. So the beneficiary does not need to live in PA in order for you to take the deduction. The plan does not need to be the Pennsylvania Section 529 plan. So you can have a grandchild living in California and you're going to pick the Michigan 529 plan. You can still take a deduction. Now, the deduction is going to be the lower of the contribution, obviously, or $16,000 or your amount of Pennsylvania taxable income. So if an individual has maybe contributed $200 per month for the benefit of a child or a grandchild, you can take up to $2,400. All you need is the social security number of that beneficiary and how much was contributed to the 529. So you do get a deduction on the PA return. A nice program, particularly if you're thinking about making a contribution and you have a little bit of income that's kind of escaping that withholding, and you end up owing a little bit each year. Great way to get rid of that. Also, that what can be deductible is an HSA contribution. So if you are allowed a deduction on your federal return, meaning that you made that deduction with after-tax dollars, so any pre-tax or made by the employer won't qualify. But if you made an additional HSA contribution, we can actually take that as a deduction on the PA return as well. So again, if you have that opportunity, not only do you get a federal benefit, but also works for PA. The last program I just want to talk about is a PA ABLE. So this is Pennsylvania Achieving a Better Life Experience Savings Program. So this is a program designed for individuals with disabilities. It provides an account, almost like a trust account for them to use for disability related expenses. It is completely tax-free. The earnings are tax-free. The distributions are tax-free. The benefit is that the person receiving the funds can still maintain their government benefits. That's not considered income for their government testing of how much they can provide. So again, much like the 529, you can take up to $16,000 in contributions per year. And the same rules. It's going to be the lower of the contribution or Pennsylvania taxable income. A couple other issues with the PA return is that we do need to put down the school district on the PA 40. It's going to ask for a school district code. So I mentioned at the very beginning of our training sessions, we want to use the address of the individual when they're getting their return prepared. What's their current address? Not what was it during 2022, but what is it today? The one exception we have is for the Pennsylvania return. What we want is a school district where they lived as of December 31st. So if we had an individual who lived in Lancaster City for all of 2022, and in 2023 they decided to move to Willow Street, we want to use the Willow Street address for the federal return, for the PA return, for the local return. But for the school code, we want to use the Lancaster City or school district Lancaster code. So we have those replicated here. They're also available for you in a state guide that I believe we'll have available at your sites and also electronically. So you don't need to memorize these, but generally, if an individual doesn't know where they live and you ask them, did you change addresses? And they say, no, we can look at the prior year return. Usually they have a pretty good idea of what school district they're in because they're probably concerned about school-based taxes. And we just came out of an election season where we may have been voting for school board members. So the school codes we would use on the return. And then the last piece I just want to kind of mention here for Pennsylvania purposes is one of the more popular programs. We actually have a fairly good amount of people coming into VITA just for the PA Property Tax Rent Rebate Program. So it is a program designed to benefit eligible Pennsylvanians who meet one of three categories. They're a senior age 65 or older, they're a widow or widower age 50 or older, or they're a person with disabilities 18 or older. So what we're looking at here is a very popular program, but we have very strict income limits. These limits haven't changed for quite some time. For all the years I've been preparing returns, I haven't recalled a change here in the income limits. The downside is that these are strict limits, and I'll go through what those look like in just a second. For an individual who owns a home or the homeowner portion, the property tax rebate, they can earn up to $35,000 a year and still get a benefit. For renters, it's much lower. It's only $15,000 annually. And how is this calculated? Fortunately, we don't have to do any calculations. It's automatically going to calculate whether or not they're going to be eligible. Again, we have to indicate that they're eligible for the property tax rent rebate. Again, much like with the SP, we can go ahead and select that just to make sure the calculation's handling appropriately. Up to basically 50% of your Social Security income and railroad benefits will be excluded, meaning we almost take your PA return and we add 50% of your benefits back in. We also take a look at the now is when we see those retirement distributions come into play. So much like the SP schedule, we have to add a couple things back. That would be the inheritance, any alimony, any spousal support and gain from the sale of a personal residence have to be included. So those would come back in our calculation. The standard maximum benefit is $650, and I'll go through kind of the process here. The question came in, the 35 of earned income or gross. So it's actually a little bit of a blended area. So it's really kind of taking a look at your federal income in a way. So we're going to be taking a look at your distributions from retirement accounts, half of your Social Security, any interest, any dividends. So again, we're looking at people who are generally retired. So most likely coming through on Social Security and your retirement distributions, any investment accounts. So that is going to be based on just adding back 50% of the Social Security that is earned. The maximum benefit is $650. That's a standard rebate, although we may have people coming back and say, I don't know what you did. Last year you requested a $650 and I got more. And the more is fine. It's not that something we've messed up. It's not something that was a problem with the system or the program. So we actually have an additional property tax benefit. So if the individual has less than $30,000 of income, and they pay more than 15% of that income in property tax, the state will automatically make an adjustment to their rebate. So they can actually get an additional up to 50% for those senior households if they meet the other qualifications. So those would be areas that we take a look and see. We'll file the PA 1000, which is what we call the property tax rent rebate form, and the state may make some adjustments. Typically, we want to file these returns as early as possible, generally at the same time we file the PA 40 and the 1040. Now, we may have people who just want to file the PA 1000. However, when we prepare the return, we're going to have all the other information in there needed for the 1040 and the PA 40. So we can go ahead and file those returns as well. There's no harm in filing those federal and state returns. But if we do prepare the property tax rent rebate, there'll be a couple things we'll need to keep in mind. Just want to kind of go through again those income limitations. So the income from a homeowner, 0 to up to 8,000 gets a maximum rebate of 650. Between that 8,000 and 15,000 goes up to 500. 15,000, this is only a small area here, up to 18 gets to 300. And then your final one is at $18,001 up to 35,000, you get 250. These are cliffs. So once you get $1 above those thresholds, you go to the next level. If you have $35,002 of income, you're going to get nothing. Unfortunately, that's the way the PA system works. So you may have individuals that come back and say, well, why didn't I get a property tax rent rebate this year? Well, maybe they had additional items coming through that they took more money out of a retirement account. Maybe they had gambling winnings. Perhaps they had gains from the sale of securities that pushed them over the limit. For renters, as I mentioned, it's a much smaller threshold. So for renters, it's only up to $8,000 to get you the full 650, and up to 15,000 will get you 500. Anything above 15,000, the renters are unfortunately not going to be eligible for the program. So again, these numbers, these income thresholds haven't changed in quite some time and could be problematic coming up because we're seeing a greater increase in Social Security benefits. So for the fact that these numbers haven't changed, we may be seeing a lot more people, not necessarily for 2022, but perhaps 2023 who will no longer be eligible for the program. So hopefully this is something the Pennsylvania General Assembly will take a look at and hopefully make some modifications to get these numbers corrected for more modern times. Just a couple things to keep in mind with the property tax rent rebate. We do need to go ahead and have some attachments to prove the income. Good news is if they've been in Pennsylvania for the entire year, you do not need to attach the Social Security SSA 1099. Pennsylvania already has a copy of that. So you do want to just double check with your site coordinator to determine what packet they put together here for the PA property tax rent rebate. Typically, we're going to attach parts of the federal or state income return to show the income. Typically, it's going to be page 1 of the 1040. You can also attach Form 1099 for any pension, annuity, or any other retirement income. Now, depending on which credit or rebate you're going for, if you are going for the property tax, as a homeowner, you need to attach proof of payment of real estate taxes. So the easiest way, if you are still paying a mortgage and your property taxes are paid through escrow, you can attach the Form 1098. That's going to show the amount of taxes paid. That's the easiest way for us to go ahead and demonstrate the taxes paid. Another way that can happen is if you have a copy of a receipted tax bill. So when you pay your spring and fall taxes, you can actually go down to the local tax office, wherever you're paying those, and they can give you a receipted copy, basically a certified copy that you paid the taxes. If you don't have a receipted copy, you can also get a copy of the tax bill, and you have to have a copy of both sides of the check to show that they were made out and they were also cashed. So that's the documentation we need to prove our real estate taxes. So while we may not need that information for itemized deduction, we'll probably need to find out how much a homeowner paid for property tax for purpose of the PA 1000. If you're a renter, you need to have a PA rent certificate form, and that's actually going to be signed and completed by the landlord. Oftentimes within VITA, the individual will already bring the form with them completed, which is great because then we can just finish off the return and perhaps even get them ready to get mailed. If not, we can go ahead and prepare the forms as much as we can and just indicate to them you need to go ahead and have this form now signed by your landlord before you file away. Just a couple other pieces with that property tax rent rebate for the PA 1000. If they've been filing for a couple of years, that's all we need to do is to give the calculations, the PA 1000, and the items required by the state. For first-time filers, we need to go ahead and have a couple pieces of identification. So first thing is proof of age. So if you have just now turned 65, or you moved in the area and you're 65 or older, Pennsylvania wants a copy of the following documents or one of the following. It's always interesting. The first one that pops up here is a birth certificate. So if you've ever looked at a birth certificate lately, and most of you probably have not unless you went to go get your real ID for PA, the birth certificate issued by the Commonwealth of Pennsylvania says in clear bold letters, do not duplicate. So the birth certificate says, do not make a copy of this under any circumstances. Except when we get to the rules for the PA 1000, they say, you know what we'd love to have is a copy of a birth certificate. So I'm not going to get an argument between the various parts of the Commonwealth that say do or do not copy. But if you have a birth certificate, we can make a copy of it and send it with the PA 1000. If you don't have a birth certificate, the hospital birth records could suffice. Not quite sure we see many of those around. I still have a copy when I was born before the birth certificate was issued. So a little notification from the hospital say, hey, baby was born. Not the best of ID. You can use a driver's license. You can use a passport. Copies of those are sufficient. If you have a Pennsylvania ID card or a Medicaid card, those are fine. Same thing if they qualify for PACE or PACENet, those would be eligible copies for age. If you're a widow or widower between 50 and 64, not only do you need the age certification, but you also need a copy of the death certificate. Again, a document that's not supposed to be photocopied, but for purposes of the PA 1000, you're fine to go ahead and do that. Now, for permanently disabled individuals, we normally basically take an individual's word if they're permanently disabled for purposes of dependency or maybe some additional standard deduction. For the PA 1000, they're a little bit more strict in what they require. So if an individual is receiving Social Security Disability or SSI, they will normally have a copy of an award letter from the Social Security Administration to say that they are permanently disabled. We can include a copy of that with the PA 1000. For any military veterans, and they are deemed to be disabled from the Veterans Administration, we would just need a copy of the VA letter to attach to the PA 1000 as well. For all others, if you're not on SSI or you don't have a VA disability, we would be required to have what is called a PA 1000 PS. The PS stands for physician statement. So that would be a signed certification from a physician that you meet the eligibility for permanently disabled under the Pennsylvania property tax rent rebate rules. So that's kind of what we'd be taking a look at for the PA 1000. Okay, just want to double check and see, do we have any questions on the PA returns before I move over and give you a little bit of background on deceased taxpayers? So any questions arising here? Okay, so now I'm going to switch back to elements that are going to be within your 4012, and this is for deceased taxpayers. So again, the reference you'll see in the upper right-hand corner is for the 4012, which hopefully you now have copies of, or are anxiously awaiting to go by the United Way headquarters to pick up your own personalized copy of the 4012. And if Kim and Jennifer are around, maybe they'll sign the front cover for you if you like. We'll see if that's an option, but they are available 24 hours a day if you'd like to pick one up if you haven't had one already. So just a couple basic rules with deceased taxpayers. If an individual are married filing jointly and only one of the spouses has passed away, they can still file a joint return, provided that the surviving spouse did not remarry before the end of the year. So it's a very nice process. So if you have an individual that came in and they basically said, my spouse has died this year, you can still file the return jointly, provided they did not remarry. So as long as they say my spouse died, and by the way, here's my new spouse. We met at the funeral. We got married a couple of days later. That becomes a whole bigger issue. They would have to file a joint return. The ones that are married, the deceased would be filing separately. Big issue. But as long as they have one surviving spouse, they can file jointly. The surviving spouse is going to be able to sign on behalf of the deceased spouse. So we can still file electronically. The best rule of thumb is once that return has been rolled over, go ahead and change the primary taxpayer to the surviving spouse. So we just want to change the information. So for next year, it'll actually roll over better and also be able to be electronically filed. So if you have a married filing jointly couple and only one has passed away, bring the return over, and best practice, go ahead and change the surviving spouse to the primary taxpayer. Again, in the information section, when you're in the very beginning part of tax layer, there's a box to say taxpayer is deceased, and you simply enter the date of death there. So it gets a little bit more complex whenever we have no surviving spouse to sign the return. In that case, we need a personal representative to file and sign. That's probably going to be the person bringing the information in. So typically that might be an executor, it could be an administrator, it could be a family member, whoever's in charge of administering the deceased person's property. So that would allow them to actually file and sign the return. Again, generally we can do that with an electronic filing. It gets a little bit more complex when we have the scenario where there's no surviving spouse, the taxpayer is deceased, and there's a refund on the return. So if there's a refund on the return, there's a form 1310 that has to be completed. And within the 1310, there's a section where you have to indicate the relationship of the personal representative to the deceased person. So there are a couple options, A, B, and C. So if it's option C, you can still electronically file a return. If it's option A or B, unfortunately, that federal return has to be filed by paper, because there will be some additional documents that have to be attached to that. So if you select option A or B on the 1310, it's automatically going to let you know that that return has to be paper filed. There are some ways we can still electronically file the state return, but the federal return is going to have to be paper filed if option A or B is selected. Okay, so there is our update on deceased taxpayers. Good news is that once you do it one time for that taxpayer, you don't need to do it again because they are now deceased. So the last time we have to worry about that issue for the deceased taxpayer. I do want to warn you, the 1310s, when we file by paper, can take some time, even though the IRS is back to full staffing, according to them. Well, actually, according to them, they were never not fully staffed during the pandemic. They were still working. But during the pandemic, I have seen 1310s take up to 2 years or more to get a refund. So again, paper returns, we highly discourage a paper return because of the additional processing. So if we have to file, we have to file, but just warn individuals, it may take a little bit of time for that refund to come back. So at this point, we're going to switch over and talk about military tax issues. So I just want to take a little bit of a pause here because this is actually a different certification. So we have the basic, we have the advanced certification, and then military is another layer of certification. So if you're not interested in the military certification, you're more than welcome to exit and enjoy the rest of your evening here. Just want to say what a pleasure it is to be able to work with you, see some familiar faces, even though we're on screen here. But want to wish you the best of luck here during the tax season. Always love doing these updates, and this is a great year because I don't have as much new stuff to throw out at you, and we're getting easier with the returns this year, back to normal, right? No longer do we have the advanced child tax credit payments we have to worry about. No longer do we have to ask the client, did you get all of your your economic stimulus money? And the question, I don't know what you're talking about. Okay, great. So let's ask some additional questions. We're back to normal as best we can be. So just want to wish everyone the best of luck here in the tax season. If you have any questions that arise, feel free to go ahead and pass those through the chain. Both Kim and Jennifer know how to get in touch with me. I'll be in the trenches as well here with returns in the spring. So we'll be able to weather the storm together here. So again, you're more than welcome to stick around for the military tax issues. If you'd like to drop off, again, just a pleasure to be able to catch up with you again this year. And enjoy your holidays and good luck with tax season. All right, so we'll get into the military tax issues. So for individuals who are interested in preparing military taxes, we're going to go ahead and talk a little bit more about what some of the unique rules are with these. So VITA's actually been preparing military returns now. We're in the 7th year. However, I just want to caution you, we don't see a lot of these. So if you see one, absolutely, we can take our time to do these. There's a little bit of complexity with the military returns. We just have to kind of take our time walking through it. A lot of it's going to be fairly straightforward as we talk about a couple things, but don't be afraid to hold on to it. Don't be afraid to ask for questions. Again, we don't really see a lot because we're not near a military base. But there may be some issues we see with the moving allowances or maybe combat pay. I do have a couple clients in this area that are active military reserve and a couple others that have been on active duty. So we may have a couple questions coming out. So while the 4012 has information on the military, the reference I'm actually going to suggest is actually the publication 4491. So not a form that we typically hand out for VITA, but you do have access to it online. So if you just type in publication 4491, that is going to give you a PDF copy. It's a great resource, not just for military, but for other issues as well. So it goes through a lot of different tax law issues and some great examples to really be able to help people kind of understand what's happening in the world of taxation. But especially for military issues, a lot of great information in the 4491, a much more robust section on military concepts. So just want to give you a couple overview items here. Again, in their 4012, the D3 is going to give you a little bit of summary information for the military activity. So that's going to give you a list of the information that's taxable and non-taxable for military purposes. There are a number of things that could be either taxable, such as regular wages. Non-taxable would be things. We'll talk about combat pay. We'll talk about housing allowance. But there are some interesting things that are taxable or non-taxable. Generally, the government's going to do a fairly good job of preparing the W-2. Fair warning, government uses the lowest paid contractor, the lowest cost contractor to do these. I have had some issues with W-2s in the past, but in general, in the past couple of years have been pretty good. However, there may be some unfamiliar codes in box 12 of the W-2. As long as anything's in W-2, box 12 of the W-2, enter those as you see them. They're automatically going to go to the correct parts in the software and go through any of the calculations. A couple other unique things we have with military is they may actually have some moving expenses that can be either deductible or taxable depending on how they do their move. And also, I'll just finish off with a quick discussion on employee expenses. So we talked about the Schedule UE here with the state taxes, and that's the only place we could take normal unreimbursed expenses. For most of our civilian employees, they can only take it for state and local. Military can actually take that on the federal return if they are able to itemize their deduction. I'll kind of finish with that concept. So a little coming attraction, we'll finish off with talking about military deductions. But in terms of military income, again, the W-2 will generally show the taxable amount in box 1 of the W-2. So there will be a couple things that we'll take a look at. I'll kind of mention a couple different areas. One question we often have is kind of the difference between severance pay and disability compensation. So as individuals may be separating from service, typically the government's going to call that severance pay. So even if an individual is discharged for medical purposes, the government may consider that as severance pay, which would be taxable. So even though you have an individual and they say, well, I was discharged medically from the government, I don't know why the W-2 is showing taxable wages, it should be disability. Oftentimes we would have the individual apply to the VA office, and the VA office will go ahead and determine disability. And if the VA determines that their separation was actually due to disability, as opposed to just a medical condition, the VA will now call that a disability award. And that payment now becomes excludable. So from the time the VA makes that determination, the W-2 should be corrected. So one point I just want to make is that when the VA makes their determination, they're going to go back to the date in which the separation occurred. So if they're going to indicate that the military was initially incorrect, that it wasn't a medical discharge, it was actually a disability discharge, we would have to go back and amend the returns that have originally reported taxable income to show that is non-taxable income. So we can actually go ahead and apply for refunds for those prior years. Again, bringing Kim and Jennifer in for the first year, probably the last thing they want to hear is about doing prior year returns with amended, but we fortunately have plenty of time to be able to work on those. So once you get your feet wet with the regular return, we'll show you how to do the amendeds and get those processed. So basically, the amended return issue is only going to be a problem in the year which they get the determination letter. So that might impact kind of the prior year returns, but after that, moving forward, it should be fine. A couple other things with the military incomes, we talked about combat pay. Combat pay is actually not taxable. So if you're serving in a combat zone, combat pay is excludable. Good news is you don't have to ask the individual where they were stationed. It's automatically going to be calculated. So the government knows exactly where they were. If there is combat pay, it's not going to show in box 1, but it is going to be listed in box 12 with a code Q. And the reason why it's there, it's not taxable for federal purposes. It's actually not going to be taxable for PA purposes either. But what we're going to take a look at is that combat pay in box 12 can actually be treated to be taxable income for EIC purposes. So it can actually allow an individual to qualify for earned income credit. So that's one of the benefits of having the combat pay disclosed on the W-2. A couple other things that we take a look at: the homeowner assistance and basic allowing for housing are not taxable. They're not going to show up on the W-2, not reported as taxable income. And as I mentioned, there may be some things that we see with moving expenses. So I'll talk about that in just a little bit after I kind of make a mention here of some state and local issues. So general rules for PA: any compensation you earn by a PA resident is generally going to be taxable. However, when we take a look at active military duty pay, while you're stationed or training outside PA, is exempt. So if you're training outside PA, if you're stationed outside PA on active duty, that should be exempt from PA taxes. The problem we have is oftentimes the W-2 is not going to show that correctly. Or may not have the correct amount of PA tax withheld. And to make the complication even further, they oftentimes don't have any local wages or local taxes withheld either. So what do we have to do to get this to be corrected? Well, I do suggest, if you have an issue with an individual that has been on active military duty outside PA, or that have been in training. So as I mentioned, my National Guard clients have a lot of Title 10 and Title 32 trainings outside of PA. We do need to have copies of those military orders. They're generally pretty easy for most of our reservists to get a copy of. We'd actually have to send a copy of the W-2 and the military orders, or alternatively, their CO statement with the return. But I highly suggest taking a look at the PA REV 612. So that's actually a brochure on military pay and is specifically designed for addressing the issues of training and combat outside of Pennsylvania, and will give you a good idea of what's taxable or not taxable. This process will take a little while. So again, this is why we encourage you to hold on to the returns and make sure we're doing it correctly. I've run into these issues, and it's taken a while to get the returns to be processed correctly by PA. So it just does take a little bit more time, unfortunately, with these military returns. A couple other things I just want to mention about military moving. So anytime that an individual moves as a permanent change in station are deductible. So if you're moving from one base to another, it's going to be a deductible move. However, we don't really see that here in Lancaster County that much because there's no bases here in Lancaster County. So what is included in the moving expenses are moving your household items and your personal effects, and any reasonable travel or lodging expenses. And it's basically for the service member and their family. Now, there may be times that we may have a deductible expense. So if you have incurred those moving expenses, you can file a form 3903, which will give them a deductible moving expense. Again, only allowable for military personnel at this point. If they are reimbursed, and the amount that they're getting reimbursed is actually higher than what they actually had received, it'll be taxable income. If they get reimbursed and they don't cover all of those expenses, those additional expenses are going to be what we consider those deductible costs. So as we mentioned, generally the way that we may run into some taxable income is that if you have a personally procured move, a PPM, formerly known as a do-it-yourself or a DITY move, that's generally where the individual says, you know what, while the government's willing to move my things for me, I would rather pack up my own stuff and move it across country. So if a service member or the family wish to do it themselves, the military is generally going to determine how much it's going to cost them to move, and they will pay them 95% of that cost. So typically what would happen is you would have to substantiate your actual expenses by submitting all your receipts to the government. And if the government incentive payment is actually higher than what you had done, because you somehow are more frugal than the government and you figured out how to do that a little bit cheaper, unfortunately, any excess portion of that reimbursement is now taxable income and will most likely be reported on a separate W-2. Again, if you have any additional costs, whether that's mileage or lodging incurred in excess of any reimbursement, that's what could be deductible on that form 3903. And just last piece I want to talk about with the military expenses would be that we do have some unreimbursed expenses that could be deductible, not only for PA, as we mentioned, for the Schedule UE and local, but also for federal. So the only way we can take an unreimbursed expense for federal purposes is for military personnel. So this, again, it would have to go through a Schedule A, so they'd have to itemize deductions, but they could have the ability to take some deductions here. So what we're typically looking at would be things like unreimbursed uniform expenses. So that includes cleaning. It can be including any of your epaulets. It can also include any insignias that are required. And the main reason is because generally you're prohibited from wearing your uniforms off duty. So again, if you have cleaning expenses, if you have to shine your shoes, one of my good friends in college was in the Marine ROTC. I would trust him to shine shoes for the rest of his life. They were like reflective mirrors. He's very good at that. Others that he was stationed with went outside and get someone else to polish shoes. Those would be deductible expenses. They are required for military wear, not suitable for general use. So cleaning of uniforms, your any of your insignias would also be deductible, as long as it's not allowed for off-duty wear. One area that we may see a little bit more of would be for our reservist. So if you are on reserve duty and you have a 100-mile rule, so basically that where you're stationed for reserve duty is 100 miles away from your home, you can actually have travel expenses for that reserve duty away from home. That will be deductible. So that it does include your mileage. It could include housing, although in most cases, usually for reservists, they're offered housing at the base. But if for some reason that you have to have it off base, that could be deductible as well. So any travel and lodging expenses. Professional dues, you can also have that deductible as well, as long as they're for general professional dues. They cannot be social clubs. So you can't have an officers club or an NCO club dues. They're non-deductible. Educational expenses can also be deductible as long as they're required for the current trade or business. So if you have a pilot and they're taking additional training courses, maybe to qualify for instrument ratings, or perhaps they're a fixed wing pilot and they want to become more trained in helicopter and they're going off to flight school, that would be deductible as long as it's required for their current trade or business. So if they're going off and the government's saying, we want you to take the training and we're not going to pay for it, particularly for reservists, it may give them the ability to have that taken as a military business expense as well. But it has to qualify for the current trade or business. So if you have a fixed wing pilot, they're tired of flying big planes and they want to become an accountant, they unfortunately cannot take those expenses. So it has to be related to their current trade or business. And again, I just want to kind of reemphasize that the publication 4491 is probably your best area to take a look at additional information for our military personnel. So again, we don't often see these here in PA, particularly here in Lancaster County, but there are a lot of great opportunities here for individuals to take advantage of some of the deductions allowed to them for serving in the military. So that is pretty much what I wanted to cover here for tonight's session.